Let's continue this conversation, see what it means for the markets as well. Joining us to do that is Michael Schumacher. He is the head of global rate strategy at Wells Fargo, and Sarat Sethi, who is managing partner at Douglas C. Lane. And Sarat, I'd be feeling pretty good about everything right now if it wasn't for this December 15th trade deadline that's kind of looming over us. Reports last week were fantastic.
Exactly. I mean, if you look at where the economy is, it's stable, things are getting better. It's a question of what happens with the tariffs. Now, our view is if the tariffs don't come on, I think we still have a ways to go. The market looks like it's adequately priced, and there are areas in the markets like the financial services, home building products, I think are adequately. We have really good opportunities in those. They're trading at multiples way below the market and actually have really good balance sheets and have good earnings trajectory.
However, December 15th happens next Sunday,
right,
which means Monday morning you're going to be coming into we don't know what at this point. And how would you place your bets ahead of that?
So what I'm doing is the cash that I have on the sideline, if that does happen and the market sells off like we saw last Monday, there are going to be some really good opportunities out there. And I think good, high-quality companies, whether it's the Visas, MasterCards, Honeywells, all of those that have done really well this year, I think will be sold off. That's when you go back in if you've missed those.
Do you think the opposite is true? If there is some sort of a détente or a continued kind of status quo as of Sunday, will the market actually push higher, or has most of that been baked in?
I think a lot of it's been baked in, but I think then you're going to have companies that really weren't forecasting additional growth. That's where the money's going to chase. And I do then fear that down the road, you might get this real push in and the markets could really run. Not a bad thing, but then you have to be really careful because valuations on some of the growth stocks are already extended. That's going to be an opportunity to take some money off and kind of say, okay, where do I really want to be for the next couple of years? Because now we've got a pretty fully valued market, especially the momentum side and the growth side, which I think today is very fairly valued.
Michael, let's talk about the rate structure. The 10-year on this Good News Friday pushed above 1.8% again, kind of watching things firm up. You don't even think the FOMC decision this week is going to be the most important announcement we see from the Fed, though. Why is that?
No, it's trade. You just hit it. Really, Steve's point, the FOMC is pretty well baked in, probably won't do much. The most interesting thing out of the Fed this week will be to talk about repo. I know it's bad to talk about repo Monday morning at 7 a.m., so we'll set that aside. But trade is really the dominant factor. So if there is some sort of deal, maybe not this week, but in the next month or two, we think 10s probably push up to 210, 215 in yield, something like that.
Huh.
If by some amazing miracle, and it is the holiday season.
That's a pretty rapid move.
Well, not really. I mean, 25, 30 basis points, it sounds rapid in today's context, but that's not a huge move in the bond market. Think about where the 10-year began this year, 268. So it's already come a long way, and it could retrace a fair bit of that fairly quickly, but even more if you get a really huge deal. Bottom line, though, we think it's going to be something moderate, but probably not for a few months. And it's sort of a mini bear market, I would call it.
So, Rob, what happens if rates firm up like that? How does that impact equities?
Well, I think then the financial services sector will do really well because the whole fear of that inverted yield curve that we had this market completely sell off, especially on the interest-sensitive stocks. So financials, I think, especially the big banks, the regionals will do really well. You'd have to be careful on the REITs and utilities and staples because money's going to flow out of the dividend substitution stocks into some of the, I think, cyclical and value stocks where I think the opportunity will be. So there could be a rotation in the market. And to your point, you might not even see a huge rise in the overall market, but within the sectors, you'll see a rotation. And I think that's where investors have to be kind of careful.
Becky, I think that the market's got some kind of zen going here with the trade war. And I think that they're off of this idea that it's going to dramatically derail the economy. Mm-hmm. I think there's an acceptance that it's a drag on the economy, and it's probably a couple 3/10, and that the economy can grow at potential of 2%. GDP can grow at 2% with a consistent trade war. I'm really embracing the idea that Jim Bullard came up with a couple months ago, and I think others have as well, which is that there is no kind of it's going to go away. The trade war and the conflict with China, you saw the story in the Times today about the WTO and what's happening there. This is part of the fixture from now on. And what is that old the subtitle to Dr. Strangelove? How I learned to love the bomb or love bombshell trade reports. I think the market has a certain thing with it. It's like, okay, this may or may not happen, but it's not going to be the most consequential outcome of all the things.
What about
out
a story we kicked off the morning with that China is now looking to tell its state firms and state enterprises and its own government that they're going to have to rip out any international, specifically any American software that they're using. And that could impact companies like a Dell, a Microsoft, all kinds of others as they kind of retaliate for the Huawei ZTE situation. What does that mean?
I mean, this is 2 steps forward, 1 step back. And I think a lot of the American companies are baking this into their forecast, that the growth that you're really seeing from China for the next 3 to 5 years, you have to actually moderate that. And some of it might be, headline news, like your software's not going to be used. U.S. is going to have that with Chinese.
That could impact on a stock-by-stock basis.
Absolutely. And the companies you're talking about are the highly valued, really PE companies, too. So they're already built in some of this. So this is, I think, another thing that investors need to be cautious of. Microsoft's a great company, but it's trading at 30 times earnings now. So you have to be careful as to what you really want to invest in and where your exposure is going to be globally, because I do think global exposure is good, but maybe not just in China. It could be more in Europe and other emerging markets as well.